Okay, so we're ready to go. I wanted to take things back this week with taking everything back to financials, where event sourcing and CQRS started, and hopefully that that will be something that everyone's interested in, because we've tried to really move event sourcing, CQRS, event modeling into uh, regular regular domains, like more mundane things like automating hotel systems and any number of projects that you may have, insurance companies. I mean, that's still a bit financial, of course, but um, realizing that any system automation can really be much better with event sourcing and event modeling for the requirements and plans. So it's nice to be able to do something that's more financial. I think we've had an opportunity in the industry to really get a lot of APIs. So this is not really out of reach of anyone to automate some stock trading or crypto trading. There's a lot of APIs available now on a whole bunch of exchanges. So people want to do that. We're going to start today with a very basic strategy, so that we don't have anything too complex to look at. So what we're going to be looking at is a dollar cost average bot with some safe securities. If, let's say, if you wanted to own some Amazon stock or Google stock, just buying the stock itself is great, but there's opportunities to really leverage automation to get a lot more money for your investment effort. And I think we're reaching a new milestone in terms of how we manage our money, with a lot more automation available. These modern exchanges with their APIs have callbacks. If you want signals from TradeView or any of these other things, you have everything you need there for signaling when to initiate your bot or any of those things. So we'll jump into our Miro board here momentarily, and make sure that we can see what we're doing with our plans for this bot. I just got to make sure our screens are all set up for viewing this. Let's see, which one do we want? Uh, that's not the one. Okay, maybe this one. I think this one might be it. Yeah. Okay. So I just open up our Miro board, and we'll make a new section for talking about this. And all right. Event. I think I have this ready to go. Yep. So this is just if you want to follow along. Oops, let me just fix my image here. There we go. Kind of out of the way. There we go. There, I'm kind of moved out of the way now. All right, so this is our regular Miro board that we use for the meetup. If you want a link to this, just join the Slack community for event modeling. You can find that on the resources page of eventmodeling.org. And in there is a links for the actual Miro board, so you can use this as an example. I will be adding, just as a side note, I will be adding a template to Miro for event modeling, so that if you want to start with event modeling, you can just start to search for a template in Miro templates when you're starting a new one, and it'll give you a ready-made event model that you can then start with. And this is going to be an ongoing kind of effort for the community to have some recipes. We had someone stop by the office yesterday, and they used a really good analogy of having recipes in these different types of workflow or any kind of things that you customize, even for your own life. And so we'll have some recipes for financial stuff like this, some recipes for more mundane things like automating a hotel system, maybe some point of sale systems, and that should allow people to really get going with event modeling very, very quickly if their particular organization is in a related field. They could really start quite quickly with that. So anyway, back to the subject at hand here. We have we'll want to talk about what a trading bot is. And so essentially a trading bot is something that you would do manually, but probably on a much larger time scale. You might revisit your portfolio, rebalance it every month, every year, depending on what type of investor you are, what kind of stocks you want to hold. But the bots allow you to do some optimizations when you're trying to acquire something. So for example, if you wanted to increase your holdings of something like Google, you might have a chart that goes something like this. Where's my free draw on here? Oh, there we go, pen. All right. So, if you look at a stock, it's going to take a while to draw. Or is it the wrong color? I think it's too thin. Let's try that. There. Now we can see it. Maybe I should zoom in 1 second. I think I'm too far. Zoomed out too far. And these lines are too thin. Even there. And let's see if I can delete that really thin one. So just got a point of reference here as to how tiny things are. Yeah, they're very tiny. So if we can read this, then we're at 77%. Let's just go to 100%, and then we can draw with whatever we need. So we can go somewhere here on the map and start to draw again here. So, all right, I can go back to a regular. Okay. So what happens when you want to buy some stock? So, Google or Amazon, usually they slowly, over a year's time, they kind of increase in price. So you could just pick a time somewhere in here and just buy something and invest your whatever capital you have. Let's say you're going to put $1,000 of your capital in this. You can buy it here, and then that's a great deal, although the price has come down and all that. Well, with bots, you can automate some of this so that you can play around with this. With the worst thing that can happen to you is that you end up, actually owning that stock, which is what you want anyway. So might as well take advantage of having an ability to automate some of that. So the way bots work, and the one that we're going to be talking about and trying to automate, is they allow you to almost instantaneously, compared to your own speed, react to the market price and be able to put in an order. at whatever price. DCA, or dollar cost average, is just a
Uh,
way to,
Adam, sorry to interrupt. I just want to ask, I mean, how to
yeah.
see the screen, how you are sharing. Actually, I am just hearing the audio. So there is only way you are also presenting any board or something.
Yeah, let me share it on here as well, because I'm on YouTube, so I'm going to do that here. One second, let me share that screen with you. It's just one graph. Here we go.
So, okay, so you are live on YouTube. Okay.
Yeah, yeah, live on YouTube. So um, you should see something in
Yes, yes, now I can see.
yeah.
Yes, please
So
go ahead.
there you go. Sorry about that. So yeah, basically you want to be able to add some security. You can, if you're into crypto trading, you can do this with crypto. So if you want to acquire Bitcoin bit by bit, or Ethereum, or any of the altcoins, there's a lot of exchanges. I mean, a lot of the automation that's happening for exchanges is really cutting edge on the crypto stuff. It's all really highly automated, so there's a lot there. I think with APIs on some traditional stock exchanges, that's available to the consumer, you're probably going to have more limited functionality or more expensive access in terms of the fees per transaction. But the nice thing about crypto is that there's all sorts of incentives, to the point where some even waive all trading fees for, as if you're a market maker, meaning you're putting in orders and not just taking market orders, meaning you instruct the trade, so the exchange, to put in an order on the order books. You're not just instructing it to, hey, give me, this security at whatever price you have. So dollar cost averaging is basically, instead of buying something here, you notice that you will probably say that, if I bought something here, but if the price comes down, I'll also buy some more, when the prices I see has reduced a little bit more. So you'll keep buying things on the way down, and maybe your strategy is to keep buying if there was a retraction in price that's more than 10%. So you would buy here again, and here again, and here again, and you'd give yourself a budget for that year, that you can spend all of this $1,000 at these points, versus putting all of that money at the same time. That may not be as good here, because obviously there's, maybe this is not a good example, because the price went up quite high, so you might be okay. However, if you're automating this, there's a way to automatically instruct a bot to do this without having you looking at this manually every time. And so how dollar cost averaging works is by basically setting some basic order to start with. So let's say you have $600 or so that you want to invest, potentially. You start out an order for, let's say the price is at somewhere at like maybe 100. Oops, let me use a different color here. So if we have a price that starts at $100, and you say, you know what, I'm happy to buy this at $100, and that's going to be our initial start. But then, if the price goes lower, it's more of a deal. I'm going to get something at $98, at 96, etc., all the way down. Because it's a bot, we can do this for 20 deep or something like this. Effectively, what that does is it brings down your average price of purchasing. So if you bought, let's just write down this, that we have this at 98. So we're moving down in $2 increments, usually done as percentages. But if the price continues to go down, we can basically, as each of these, so this is called a basic order, and these are safety orders. So we have 20 safety orders here. And as things move down and the price makes it okay to buy for this, we keep acquiring this security at these different levels. And depending on how much we allocate, usually this can be just the same amount, $10 at each one. But if we have 20 of them, obviously, it's going to be about $200 or whatever it is that you want. And then your effective price in here ends up being somewhere in the middle. So if you went 20 down, that'd be $40. That'd be, your average price would be 80. So instead of buying everything for 100, you ended up buying for 80, a 20% discount, which is great. That gives you a lot of extra capital to play with and puts you ahead of the market. So that's how a DCA bot works. So this is a direct. A dollar cost average, because they're averaging as you're moving down. And so this is, I'll just label that here. So this is DCA. That's your DCA for acquiring things. Now, what happens on the actual, what do we need? Let's jump into actual event modeling now, to understand what happens over time when we want to implement something like this. So what are the systems that are going to be at play here? And what are let's do traditional event modeling. Let's see what events we're interested in. So obviously we are interested in, let's do our yellow for events. We are interested in bot, our initial order, which is called base order. So we have that on the timeline. We also have an event called bot safety order, and that's these discounted levels below that you want. And you can have these quite deep, so especially in the brand new markets where there's a lot of risk, you want to cost average all the way down to zero sometimes, because the price variations might be quite big. And this is a really good way to invest in a volatile market where you have where there's a lot of volatility. So manually adding manually trying to make a trade and acquire something, you might get caught on a very high price or whatever. So in a volatile market, it's really nice to have a dollar cost average. Now, of course, you can do it manually just by randomly picking times where you see a discount, even if it's very volatile, and putting in some orders. But it's really good to take advantage of this for another way, because you can just keep selling. So the other thing that happens with the dollar cost average, when you're automating a bot, is selling it immediately. So even though that you want to, so we got these two events, which is fine. We went over that. Let's look at some more concepts here before we add any more events. So the thing that you can do with this, what happens if the price is kind of in the middle, and it's going back and forth between a price range here? It's kind of gone sideways on us, and we have something that looks like this. If you have these levels in here, you want a whole bunch of buying opportunities on the way down, but you also want to get out once you dollar cost average down and you have some profit. So a lot of these dollar cost averaging bots, what they'll do is they'll sell at a 1.5% profit, very, very small amount, but because they're automated, they'll do this multiple times in a week, might be 20 times in a week. And if you can imagine getting 1.5% on the value of a stock or a cryptocurrency that often during a week, Well, that's a much better return, right? With the only downfall with these dollar cost average bots, the only downside is that you bought something that's dropped in price, and now you hold that stock until you want to sell it, and that could be at a much lower price. But it doesn't. It's not an aggressive bot that tries to play options or leveraged accounts where you have borrowed money and you have to pay these fees to keep the leveraged account going. Those can drain your account with you holding nothing in the end. At least with these dollar cost average bots, the worst that can happen is the price can just go down. Oops, let's try using the other color again. The worst thing that can happen here is that your dollar cost had averaged down, and then it just stays at the bottom. So you have your levels here. You're hoping to sell for 1.5%, but it never goes here. And you might wait a year, and finally goes up, and you can finally sell for some profit, and that locks your capital down. You have an unrealized loss. You only lose the money if you sell, somewhere in here. Because you're tired of waiting and you're impatient, and then you lose. Obviously, you bought here and you sold for a lot. You lost 60% of that particular investment. So, but for the most part, when you're going like this, there's a take profit line that you also do. So there's another event that we want to look at, and that is the event that we want to look at is took profit. So when we actually want to get out of the trade to realize this 1.5% or whatever. So when we start with this, we have, I'm going to try and get another color here. I wish there was more colors to pick from than just these, but let's, okay, yeah, let's try a blue one. And let's get the thickness back down. So we also have something called a take profit, which means if I bought somewhere here at $100 at 101 and a half, $101.50, I would sell it immediately. And so that works for the situation where we immediately go here, sell, and then the nice thing is about these dollar cost average ones is that you can, as soon as you sell, you can buy the immediate security again and continue the process again. So these are always running. And the nice thing when you're automating them is that they'll work for you 24/7 to acquire profits and perhaps the security at a discount if it ends up getting sold off, and you can actually hold it at a nice discount because you dollar cost it on the way down. So one of the nice things is when you have a lot of this volatility is that you're going back and forth multiple times selling this take profit line. Now, as you're buying more and more of these, let's actually erase this, because what happens to the take profit line as you're acquiring these things here, I should have just typed, but so this take profit line, when you set up your trade, is set here when you buy it at this $100 level. But the minute you buy one of the discounts, the take profit line drops to the average of these two prices. So it goes down here. And then when you buy the next one, it drops again because it's an average, right? And then when you get another one, it drops again. And another one here drops again. And finally, when you have the bottom one, it's kind of in the middle between your initial investment and here. And so from now on, it's here. So now in order to get out at a profit, your price only has to come up to here to get out. It doesn't have to go back to your initial investment. So this is one of the big advantages of dollar cost averaging, is that you don't need the market to continue and your stocks to continue to gain value for you to keep playing on it. As you're playing the price action, you're always driving your total cost down with these safety orders being filled. And also it increases your investment, right? So when you bought the initial one, it was only $10 or something. But as you're accruing these safety orders, it's actually increasing your investment. So when you do come back up for profit, this wasn't just a delay tactic. It actually did pile on more investment for you to do that. So we have a took profit, but we also have another associated event with this, which is profit line adjusted, right? Because as these things get put in, we have these events. Now, some of them may not be events. We'll see that these can all be, a lot of these can be reclassified as just another view of state, and we'll start to form, form a proper event model. So now the other thing that can happen with this is it can be coupled with, like I said, something like a trading indicator. There's a lot of these ways to analyze the market, if it's overbought or oversold, and if some indicator that you're using says things are oversold right now, which means the price is very likely to pop back again, you can start to initiate your bots then. But we're going to look at the very simple case of, like, I like Google or Amazon or Bitcoin or whatever as something I'd like to have as a long-term investment. So I'm not too worried about holding the bag with that security for a long time. Then we can safely play with this at buying at any price and allowing this automatic mechanism to fill things in. So how does that relate back to event modeling, etc.? Well, if we have an exchange, we already talked about some things here. We'll look at the UI where we have these indicators, so you can start to make the UI of the event model here. But let's start in this case. We'll draw our regular timeline for the event model, and then we'll look at event sourcing and CQRS and other concepts to see how we can start to automate this with actual code and write our own bot from this. So we have some events here. Our event model always has our users up here. Generally, it'll just be the trader in this case, and that's very small. Okay, so we have our trader, and maybe make that a little bit bigger, and give that, maybe there's a trader icon. Nope. Oh, user it is. Okay, so user icon. I guess that'll do. So some of these things are set up, like we already said, that we don't have. We have a bot setup, and we already said some of the things that are in here, such as the security that we perhaps want to buy Google, and that we want to have take profit at 1.5% increase overall over the average price. We want our base order to be of size $10, and then we want our safety order to be let's keep it simple, do a 10. There's reasons why you might want to actually have more money for the safety orders, simply because with a little bit more price valuation, you end up tripling your investment and getting back 1.5% on triple the amount of money as these bots keep buying and selling. And these safety orders will continue to go as that. But we also have a multiplier. In this case, we won't. So there's a safety order multiplier. And if you really think that a price dipped and you want to just double down on the money each time, it's going to take a lot more capital to do, but you can basically say something like 2, and that'll mean that your next safety order is $40, the next safety order is $80, and the next one is $160. So you can see how quickly you can start with a simple tiny base order and keep taking profits, but if the price dips, you can then use your cost average to really take that take profit line way further down by adding a lot more money. But in this case, we're going to take a simple example and we're going to have a multiplier of 1. We're just going to keep adding $20 to our investment as the price keeps falling. That'll be easier to model for now, and you can of course play with your own parameters for this once we get the code out. And oops, let's correct that. So I hope that makes sense when you look at, cost averaging. If you keep increasing this investment, this take profit line is going to be way further down each time because it's a weighted average with the amount of stock you buy at each one. And so that's what we'll do in here, is just not bother with that. So our take profit line is going to require quite a big bounce, right? Markets have these bouncing prices a lot of times, where something's oversold and it springs back. You look at stock charts and they're all over the place. They're kind of bouncing everywhere. So this dollar cost average is really neat. And anytime there's a chance for it to bounce back up, you take your profit and enter the trade again. And so notice that if this happens, you immediately do another trade, and so you reestablish your initial investment here to acquire even more, based on, I have to switch to green again. And so you would, if you reach this here, you would immediately start a new trade, and this would be your base order, and you would do the same thing. So even though the market's going down with these bumps, you're making money as long as there's enough of a volatility and things are moving up and down. So even in a slightly downtrending market, you're acquiring things for a good cost average, and selling it at a profit each time. And so the same thing would happen here, is that you would now establish that you have these levels of safety orders to dollar cost average down again, and then your new take profit line would be somewhere here. Notice it just goes up a bit from where you sold. But as and if the price starts to go down, you are going to hit again the same thing, and you're going to drive the take profit down line even further. And so it as long as it's not tanking and staying at the bottom, you're in good shape. And if you want to, like I said again, if you want to hold that security, that's your best way of having peace of mind. If you're in the high risk area of brand new cryptocurrency that some crazy guy put together overnight, and you're investing in it, I mean, there's a good chance it'll just get delisted and you'll be holding nothing. So, it always nothing. There's a disclaimer here. This is all investment stuff, and I'm not responsible for any money you lose. I'm not giving any financial advice. I'm just showing you how the mechanics of the exchanges work and how you can automate them if you want. Of course, a lot of these exchanges offer paper trade, like fake accounts. So you can put in some, $10,000 of fake money, and they'll allow you to trade as if it's real money, and you can test these things out. It's a really good programming exercise. If you start to build your system like this, and you start to talk about setting up your bot, and then you have other things here that have to happen. So I hope that that makes sense. If anyone's got any questions, I know we only have 3 participants, but let me know if you have anything. You can also just chat me if you like on YouTube. I'm looking at the chats in another window, so if you have a question, feel free to ask. So how do we do this? What other events happen? So we have took profit, but we also have these. There's a little bit of a delay. So the nice thing about event modeling over time is that we can show some of these things. Is our bot fast enough to react to a market condition? Is our bot fast enough to put in an order within a certain percentage so that the price doesn't move too fast? And do we have a choice in some of these markets to be able to participate via just putting a regular limit order versus this market order, which is usually more expensive? When you go to the exchange and say, whatever Google is at, just give me 12 of those stocks. That's a market order. It means like, yeah, I can see the chart. It's somewhere around, $2,000 or whatever it is. I want 10 of those at the current price. That usually has higher fees in it because there's a bunch of things that happens on the other side to create the proper order. It's a different mechanism. But a limit order is basically, I want to buy 10 Google stocks at this price, and you put that in as an order, and you're what's called a market maker. You're directly giving an order to the. There's a slight difference there from the financial side in exchanges, but it's quite important because that's a lot cheaper for exchanges to handle, saying that, okay, there's capital allocated at this price for this many things, and then if there's a buyer side or a seller side on that that's willing to pay that price, then it's filled. And obviously you have this bid and ask side that keep battling, and obviously your market your limit order is going to be somewhere close to that price. So below what the last trade was at, and hopefully there'll be someone from the other side that says, all right, I wanted to buy this for $2,000. I wanted to sell this for $2,002, but there's you're there with your order for 2,000. Okay, fine, I don't care about the $2. I'll go and buy that, right? So that's how this exchange works. So it's really important to capture the minutia of what can happen in these fractions of a second when all of this is automated, because when we take profit, that's not really what happened. There's a whole bunch of other things that happened to take profit or to even enter this whole thing, right? We set up our bot to buy Google and to do that. So you might have bot-based order, and that might be we just buy it at market. It's more expensive, but we don't bother with that. So it would be the type would be at market, and it's more expensive. And there we may have the fee of 0.1%, and that's what happened when we got it, and we got it at the price of $2,000, and quantity, we bought 10 of them, something like that. Well, these are really large numbers, but you can divide by 1,000 and play with a cryptocurrency for way less to do this. So that's what happened here after we set that up. But in order for that to happen, our bot needed to do something. So this is what comes back. We can start to divide up our event model into the swim lanes for different systems. So where our bot lives, where we have it sitting maybe as a running script on our server that we rented from DigitalOcean, or maybe you purchased a service that automates some of this, but we're going to be building the actual bots so we understand how they work. And you can build your own and not pay fees to some bot network that's out there. So the other thing that we want here is that there's another side that the bot does, which is submit order, right? That is something that the bot has to do. So order submitted, and there would be type market. We don't want to put in an actual thing and an actual an actual limit order with price specified. Just give me Google at whatever price is going at right now. So then we want the security to be, well, we forgot the, actually no, we have, fine, we're talking about Google here because the bot is set up for Google, so we don't have to keep repeating Google in here. But the type that it's submitted is that, and actually it's going to need to include this. No, the command is going to need to do it. I'll explain myself in a bit. The actual command that goes out to the market will have to specify Google, but I'll show you how to move that data from this initial event and put that into the subsequent command that goes here. So we have some things that happen on the stock and something that we keep track in our bot. So we already have two subsystems we can look at. And so let's do this and divide this up. And I'll use a dotted line to separate the two systems. And so here we have, so the trader is kind of looking at all this happening. And we'll have different screens for it as we do in event modeling. And here we will have our bot, and here we will have our exchange that is giving us all of this, and we have an account there. I'm not going to bother with account setup and all that. You can event model everything backwards too if you want, but we'll just pick it up from when we created the bot and what events happen. So just a quick review again. We can have all of these things that happen. We have this this dollar cost average bot. Started out here in this example. Price fell, so it couldn't sell because that would be a loss. And once it bounced back up, it caught our take profit line, which continued to move down, and then entered another trade immediately to do the same thing all over again. So we want to have that dissected here, so we know exactly what events to capture and how to orchestrate all of this. So order submitted is something that we did on this side, and so on this side we have order received. And we have that, and in this case we are going to have the security here as Google or Goog, whatever the symbol is. That's that. Took profit goes down here somewhere. Profit line adjusted is here. So what else is happening here? We have the bot needs to know what the price is. So there is a quote received, and if your exchange gives it to you, that's great. Quote received. And here's an interesting thing. We can have a set of subsystems here because we don't care about every quote. We only care if the price changed past a certain point to put another safety order, to make more safety orders. So here's another thing that I skipped over. You can't just go ahead and put in all these safety order in at once. The exchange will say you're spamming, especially if you got like 60 of these bots. You can really get crazy and say that I want to diversify. I can have 100 bots all buying $10 on very, very small prices, taking very, very tiny profits, but together they amass quite a lot of money. And if it's well diversified, then you're not really exposed by, one particular stock tanking or having some issues. You don't put all your eggs in one basket. So you can have, hundreds of these bots running at the same time and doing the exact same thing, just taking small little profits here and there, but they all really add up quickly. It's just a efficiency of scale there. But what will happen is, of course, the exchanges are going to get pretty ticked off if everyone that's on there has 100 bots and each of those bots put in, 30 orders that are always outstanding. That's going to be looked at as spamming. So these tend to get put in by your bot as the price continues to move down. So you usually have one or two of these safety orders just in case there's a sharp spike down. It can actually penetrate through 2 or 3 or 4%. So you want to be ready for that, and to have two orders to take advantage of the averaging down. And so we're going to have to, take that with this quote received, see what the price is, see what we actually bought, what orders were filled, how we're going to get feedback from the market, where the price is at, did we get the previous things filled, do we need to put in another safety order? So this would be to have this, where do we have it here? Order received, order market type. So yeah, we don't have the counterpart of this was a safety order submitted, safety order placed. We're going to have a few of these go in if the price is moving up and down. It's on the down part for quite a bit. We might, trigger 2, 3, 4, 5, 6, or 7 of these, but we don't want to have them all pre-made. So it's starting to look like we're getting the mechanics of this down. Now, the other thing that we're looking at here is this quote received, and what we did with the hotel example. If you remember, we had an automatic checkout system where the GPS coordinates of the hotel guests were being pulled, and we were only interested when they left the hotel grounds to send them the invoice. Well, the same thing happens here. We want to know when the price crossed a line to do something. Like if it crossed below one of the safety order lines, then we know we need to place another safety order down below a certain level. Usually that's not the way the bots are programmed. They only put extra safety orders when they get a confirmation that one of the safety orders was filled and they're replacing. So they usually have another parameter here, which is number of safety orders at a time, and you want this to be low, like 2 or 3. Otherwise you get into the trouble with the exchange, like I said, right? So so here we can see that if I was to draw this more correctly, these would actually be moved over as these are actually getting filled. The new lines only start to appear. This one might be there from the initial part, but here, as this one gets filled, we only add this one right here, and so forth. And so same with this one down here. Only once this one's filled does this one come in onto the market, and so on. So that's a more accurate way of showing. So these are all those events that I have on here. Now you can see as a timeline on the graph of actually what happens with this bot placing these things. This is directly in accordance to this. So if a safety order is bought, then we adjust our profit line, but then we also have first of all, our bot needs to know that it did receive this, so we don't talk directly that, but we also know that our safety order was filled. Should be filled, right? Not bought. So it's usually called filled. Let's start to use some of the proper terminology here. So placed and filled is probably what we want. Filled safety order. And when we know that this happened, and of course we know that we can't connect these, but for now we will take the processors out when we're actually programming this and need to know what our read models are and what our commands are. We'll start to really look in detail as to how this makes it over to this other side. For now, when this is filled, we know that, let's say we have quotes. Let's say we want to actually have quotes. Let's not do it on the filled stuff. I wanted to show you a concept here. So if we have a whole bunch of quotes as we go through in one particular piece of the workflow here, let's just give ourselves a little more room. We want to ignore these, quote unquote, sort of ignore them, but we only are interested in another one that captures that safety order crossed. Oops, crossed. Safety order line crossed. So we don't care about this noisy kind of, maybe we're checking on this quote, we have a live feed of the price, and we have, we can have a granularity of half a second or whatever that we keep receiving these, but we really don't want to do anything until something happens. And so this is this translation pattern from event modeling. If you go to the main article in event modeling, there's a translation pattern that says, okay, these are great and all, but it would really make things complex. I want to just listen to an event that's called safety order line crossed or anything else like that. So that's what we wanted to do. So then, if that happens, then we can place other safety orders and wait for the filling of that initial one that we crossed into to be bought. This is just an example. I think we're going to use the actual exchange feedback to get a confirmation on orders being filled before we place any more things instead of doing this. But you could do this, right? There's nothing wrong with that. And so, any questions so far? We only have 2 people. How many people? Most people are on YouTube. So that's no one actually. If you have a question and you're watching it live on YouTube, go ahead and type in the question. I'll try to answer it. So this is
maybe add one more thing about this, because you've got your translation pattern there, and that's one of the things that's so great about making things testable.
Right.
Is like now you can write a test in the context of safety order line crossed rather than a test in the I received 3 quotes.
That's right. Yeah. Yeah, exactly. So that's spot on, because if you don't have the translation pattern and you're not talking about safety lines crossed and things like that, you have really horrible test setups with real granular, hard to read data in there. It's not very readable to do. So instead of a test saying I have all these quotes coming in, and I have to somehow say that my initial bot was set up with this scheme for safety orders, it's really hard to read what's going on. You really only can trust the name of the test, which can fall out of sync with if you're editing it or changing it. So it's better, like you said, to use this event called safety order line cross than a whole slew of these ones. So this ends up being much more clear in terms of what your system's doing, and it removes the noise of all of this. So yeah, absolutely. Yeah, so that's kind of the way that this works over time. The nice thing is you can start to take a diagram like this, and this is what the trader will be looking at in their charts, and take this entire thing here and just move it above here. Make it bigger, and come on, and then if you make it large enough, you can show what the bot's doing at each point with the price move, with the actual events that are happening in your system, on the exchange, and on anything else that you want. And of course, in the middle here between this timeline and what's going on in the market and what's going on in any automation, these points here where we're actually having something, these are your processors that are executing things, like putting in extra safety orders. You also have things you can represent on the exchanges happening and giving you feedback. So the UI for financial systems and event modeling starts to really take on a much clearer picture of what is going on when you're talking about a dollar cost average bot versus a leveraged dollar cost average bot, or something more exotic like like you have TradingView, which is something that traders use. So not only do you have exchange, but you can have another system that gives you indicators, like I said. So you start to decorate this with indicators. So if you want something more complex than a dollar cost average bot, and you actually want to listen to, hey, the price is really likely to go up because we have this indicator, or it's really likely to go down, I can start to have this. And there's a whole bunch of things you can read about this, like backtesting through with historic data. You can run this through historic data if you have historic data available, so you can test your strategies. And usually in the past it was kind of, it was all right because you could only do this on stocks manually. But now you can backtest with a bot, saying that I'm going to have these little variables here that the bot is responsive enough within half a second. That usually gets the price within 0.5%. You can start to play with parameters for really automating a lot of the back testing and not just make it artificial with numbers, right? A lot of the back testing methodologies give you this kind of absolute, like if the historic price is at this, I will assume that I bought it at this. You can start to give slippage. There's concepts like slippage, which is the turnaround time. For example, here, the important turnaround time here is when you actually have the price go up, and you get out of the trade at your profit. What's the turnaround time for putting this back in? And is it at market price, or do you put another order? What do? Sometimes people, when they have something go like this, and there's a technical indicator from TradingView that's really, let's put TradingView here, which is one of the services that gives you indicators and all that. Not an endorsement for them. You can make your own. All of these indicators are mathematical things you can do and have your own version if you have a feed of prices or order books and other things. So if we have another system from TradingView and we have, before this happens, let's say on TradingView that an event gets emitted that says highly oversold according to one indicator, which is RSI. I forget what it stands for, but it's used a lot. So if it entered this area, and it's still in this area when you filled in your last one, maybe you're 20 turtles deep on your buying, your cost averaging down, and you say, you know what, this is actually going to be a really, really cool trade. I don't want to get out at this blue line because I know it's about to rubber band, right? I'm actually predicting it's going to keep going up. So what I'm going to do is I'm going to maybe add another trade based off of this. Maybe I'll turn the bot off and buy some more of this stock right now, and then turn the bot on for another batch of this so it continues to run. But I'm so happy with this dip in the price right now that I just want to take the fact that I've accumulated this amazing amount of this really good stock at this price, that I'm happy to just put it in my portfolio and turn the bot back on for doing the pricing. But I actually really want to have this as part of my portfolio for my retirement or whatever. Don't touch this stock anymore. I can do that. Or I can do something more aggressive. I can start to buy options or all sorts of other things on this because I have it. Conversely, if something is entirely overbought and we have something like this happen, and you know the price is probably going to correct, you know you're going to dollar cost average down with your bots anyway, but you want to lock in more profit. You might want to, because you hold, in a lot of these cases, you start to hold the actual security. So like if it's confirmed and starts to go down, you've already accumulated at this point here 2 safety orders. And so you might have, $20 or 30, what is it, $50 worth of that. Because you hold the security, you now have leverage to sell contracts on it. So the fact that, and you're quite confident because it was overbought, it's going to continue to go down. It's not likely it's going to increase in price. So you can do short selling and things like that on this to lock in even more profit to offset the decreasing price, which is confirmed. So that's how you can get, use these indicators to come in and to actually feed back to your bot to do more things, right? And that would be done through read models and other things that we do in event modeling right now. But for this first introduction to this, I wanted to just talk about the construction of this, how we're going to have different subsystems in here to talk about these concepts, and then to turn this into code that you can then run. If you go to E-Trade or Binance, if you're into crypto, you can start with paper accounts, paper trading accounts, where again this is just fake money, but it'll allow you to use their APIs for that. Or you can build your own fake service, which can get some scraped data from one of these TradingView APIs. It'll probably be like, I think the free feeds are always 15 minutes behind or something like that, but it's good enough to play with to just find out how your bot would do, and just let it run overnight and see. And if you do 100 securities or something like that, run 100 of these bots and see how you do over a day. It's fun, and it's a lot more fun when you start to realize that these are events and it's an event-driven system, so you can start to subscribe to them and start to make screens. So one of the things that you can do, of course, is to have your I have 100 bots. Where the heck am I? How much money do I have outstanding? How much money is left in play? Because you got to realize every bot has a potential to fill in. One thing we did, we forgot about this. It was a really important one here. For bot setup, we forgot about one really important parameter, and that's total max number of safety orders. You don't want to go all the way down to the price of 0, right? So, and usually it's something like 20 to 30, right? So we'll just go for 20 deep. And the important part about the setup of a bot is that if the worst thing happens and it goes all the way down, how much are you in for? If you have an account of $2,000, even though you start with 10 and your safety orders are each 20, and you have a slippage, there's a couple of other things I'm going to introduce, what's your threshold for being able to put those in, and is there a small multiplier to add, like 5%, to basically not have this $20 increase eaten away by fees. So you want 0.5% or 1.5% added to the size of these as you go all the way down. After all those calculations, if that were to happen, the price would go down. How much of your account would be eaten up by having all these orders filled? So even though you're starting with $10, if the market goes all the way down, you're going to be out $600 of investment. Now, if you only have $2,000 in your account, you can only withstand 3 of those bots to be maxed out, and that's your risk level, right? So we want to have this whole thing here, always thinking about what it would be if there's a situation where the market's really tanked and we got filled in with all our safety orders and all our bots. That's probably not going to happen, right? And then you have to start to think about, well, what's your risk aversion? Do you have some extra money lying around in a savings account that if we have, you know, Black Friday and things get dropped totally and everything's down 60% and you're in this situation, again, because it's a dollar cost average, you're not bought and you're actually holding the securities. Until you sell those securities, you're not actually out money. You just have to wait for the market to return. But that means your bots are locked. They're blocked. They can't act anymore. There's no more capital to put in because everything's locked into these trades. So you have an option. You can sell at a loss and keep them going, which may be good, or you wait until they come up. Now, the waiting is you're not making any money while you're waiting. So sometimes, depending on the amount of loss that you have and how many bots it would free up to sell something, that'd be great. Or you just add more money to the account and turn on more bots so that you continue doing that. Because you're like, oh man, that was a real hard hit. But like a lot of people say, when there's, blood in the streets, that's the time to buy. The market's kind of capitulated, and so why don't I just turn on some more bots? I'll throw in another $2,000 into the account and just turn on more bots so I can acquire some more of these stocks at a huge discount, and then I'll let the initial investments, I'll let those bots rest and stay there, and maybe in a half a year the market returns to its original place, and they'll actually come out. So those are things that you can model in this way here in those situations. If you want, I think it's more of a greater strategy, but you can certainly have a zoomed out view of what your investment strategy is with these bots, with all of these things happening at the same time. But yeah, this trading view indicator, I mean, if you overlay this with that, it's kind of neat, because if you, let me just do another color here that's not as invasive. I'll try, what's not as invasive as that? Maybe orange. Maybe I won't do it as thick. See if we can see it. So if you have like a moving average, and you have like if it crosses your moving average, it's something like this. So your moving average kind of lags, lags. That's the wrong way to do it. You have some sort of a moving average. Again, I did it wrong. My God. Okay, I need more caffeine. Okay, so if you have something like that, and your indicator is when the price crosses a moving average, right? You can show this, and those are going to be events in here. So now we've gone to a full trading view overlay, and we can show what it is that's triggering any type of market thing. So any other questions that we have about this so far? Because it's quite a lot to take in if you're new to trading bots, but you shouldn't be afraid of them, especially if you're doing, if you start understanding investments from this perspective. I think it's really good. I think the new world is going to be a lot more automated. People have so much, available in terms of connectedness in their pockets. And so, there's nothing stopping you from having an ability to turn a bot on or make a new one from your phone if you just author an interface for it, right? These are all just simple parameters that we can have automated to even create more bots or deallocate them, etc. So if you write an admin page that's a mobile friendly page, you can be sitting at a cafe looking at all this and adjust your bot, turn one off, spin up another one for a new security. There's an IPO or something, and there's a news, maybe there's some news. Elon Musk tweeted about Dogecoin or something. So you might want to adjust your parameters on Dogecoin bot and maybe add some more funds to it or whatever. But you can do that from your phone and adjust them. Let's actually look at this. This is kind of interesting. So besides TradingView, there are actual sentiment analysis things. Let me just see. Why is TradingView two separate things? Okay, oops. Actually, it's not two separate things. Anyway, so I wanted to say, so it doesn't have to be all math. You can actually have sentiment from Twitter, which is interesting. Everyone remembers what Elon did to Bitcoin, right? He sent it through the roof when he tweeted that you can buy Teslas with using Bitcoin. So all of a sudden, that whole market, crypto, just exploded, just on that one tweet. So you have Twitter sentiment, and you know what? And there's actual services now that do that. And if you do English language analysis for whether it's a positive or negative comment, you can have a service that just do Elon tweets about Dogecoin, right? So Twitter sentiment is another service you can integrate here, and maybe this is why this coin took off. You can start to correlate things, and you can say, hold on a second, I got a service here that's a really cool cool indicator. And so some automated bot things already have callbacks where you can just hook up these sentiment. I forget what there's. I heard of one that does analysis of Twitter feeds and gives you an indicator like of some heavy correlation with the securities. I think they do back testing and correlation. So when Elon Musk tweets about Dogecoin, it seems to pop up by 20%. There's a very strong correlation here. So maybe we should add that as a trigger. And the nice thing is that you can actually put those things in. So you can also look at, do all the planets line up? Am I, what's my TradingView RSI situation? Am I in a good position to buy, according to the, what's written on the package of that indicator? And did Elon just tweet about it in some positive light? Maybe I should buy some of that stock or that coin, or turn on a bot for it or something, right? So you can start to really do that, and maybe one of the things that we can do in the upcoming meetups is just to walk through. I'm happy to sign up for some of these free accounts and start to get the feeds. I think it would be really cool to actually do that and have it as a little open source GitHub thing that we could talk about event modeling the situations and how our bot wants to work, taking into account all these fun things that can happen when you're really ready to do that. And you can, to do CQRS and event sourcing, you don't need anything. You can do it you could do this in bash scripts with curl commands, right? You don't need Python or Go. Some of these, of course, when you get into large scale, you want to have the responsiveness. You're going to hold a lot of this stuff as cached information in memory to be incredibly fast and respond to the market with as little delay as possible. But when we're just playing around, those same endpoints can be reached by just a curl command in some sort of a script, in a bash script that's running on cheapest thing you can get on Linode or DigitalOcean. Write out your results into a text file. Throw that into some D3JS thing to make a nice graph of what's going on. It's a lot of fun. I think it'll be pretty cool. I did have an idea to just move things back for event sourcing to be more on the financial side. I think it's easy, the easiest domain to really learn about event-driven approaches, event sourcing, event modeling. They're made for each other. So I think we can do that a little bit. I know that my my efforts are always to make event-driven approaches something that's done by default for all domains. I still believe that. I think it's just fun to stop doing the difficult work for once and just have fun with it and just really take it to the next level for the domains that it really shines in, and then come back to other things. But if you have interest in this, I'm happy to to start some GitHub projects, and just hack around on on actual live data, and see these things at work. But for now, if you look at trading bots, there's a whole bunch of movement in that space, because since the big sort of adoption of crypto 4 or 5 years ago, there's been a lot of work that's been done. I think a lot of exchanges were not ready for it. There's a few that went under because of various reasons. Some of them technical, they just couldn't take the barrage of automation, especially ones that had some leverage. But now with some of the larger exchanges for crypto, and highly regulated ones, I think any US version of a crypto exchange is going to be incredibly highly regulated. So the risk has gone out of all that, and you still get to play quite a bit of fun stuff. If you have every portfolio, I'm not a financial advisor, but if anywhere you read from financial advisors, you have your stable retirement, you have your savings account, you have your real estate, you have your blue chip stocks, and then you have that 5% of the high risk fun part where you're like, what, I'm gonna buy some Dogecoin, or I'm gonna invest in this startup around the corner. There's a percentage of that has a potential to really take off and become quite a big investment, and especially if you have these exchanges that allow paper trading, then you can do a ton of fun experiments. And when you're in the position to have enough money, I guess, to have a diversified portfolio, you can switch that paper trading account on that exchange to real money. And if this 1% of your portfolio is high risk, you can certainly turn it on. And if your bots have been running really well on paper trading, and you own them, and it's really cool to actually own something that reflects your attitude toward investing, and you programmed it yourself, and those are your lines of code. You're not just buying something off the shelf from some service provider. You can see how you're meeting your own SLAs. Hey, are my trades going in? Do I need to override some of these? Is the exchange not listening well enough to some of these orders? Are they getting filled? Do I need to switch to a market order instead of a limit order because this bot is stuck and it's not my fault? It's something to do with exchange. And some of the stuff you buy off the shelf, I'm sure they just don't bother, because there's so many trades happening. They don't bother to give you feedback on whether one of your bots was actually not compensated properly, and their trades weren't honored and all that. But if you own your own bot, you can listen for those things. And so there's definitely things that can be indicated in your bot that, let's do this. How about this as an event? Order not filled, and you can say take profit overtaken, and we can say that it's already overtaken by 5%, and somehow it's not getting cleared. So you're actually stuck, right? If your bot can give you these events, now think about the UI for your trader. At this point, you're adding a screen here that's going to be an alert. That's going to be a toast pop-up, or it's going to send something to your phone. Alert. Orders not filled. Yeah, come on. Not filled. Goog at 2020. Take profit was 2010. Right, so you're sitting there not clearing your bot. The exchange is not treating you right. But these situations with something off the shelf is going to pretty much get ignored, right? Here you have something that'll pop up. It's like, okay, either there's some problem with the security, maybe it's some small cap thing that you're playing with and there's not enough liquidity in the market to fill that order. Maybe it's how that exchange doesn't treat you right, because maybe you're not a big enough fish. So you, in this case, if we do have this like some percentage that we didn't have, an order being filled in time, we might want to cancel that order and just do a market. And that's one of those conditions that might be not available from something you buy off the shelf. And if this happens regularly, that's actually eating into a ton of percentage, because if this price action was moving up and down within that 1.5% during this whole time that you're sitting there waiting for the initial sell order to continue with your bot, you're really hooped. Like, you can be out. These things compound, which is awesome. So that you're taking 1.5% at all of these times that you do make your take profit lines. So anytime that something is stuck, it's taking away time for reinvestment of that money. And like, if you read about compound interest, just a small difference in percentage can be a difference between $20,000 or $30,000 for a year. So by actually building your own bot, especially in an event sourced way where you get to see evidence of everything that happened on your dime and time and your information, you can go back with exact timestamps to the exchange. It's like, I want my $1,000 because you guys did this and that, right? Or please waive my fees for the next week. You guys failed on X, Y, and Z orders. And they don't want negative publicity, right? The problem is that people want a very easy answer, and so the convenience kind of moves out of the way of, moves your interests out of the way of having insight into these potential problems that you might have. Nothing's perfect. If you look at all of the stuff about E-Trade and all the stuff that you have out there for, available for consumers from fintech side, it's painted as a very rosy, very clean. They have these very polished stock video commercials of happy people with white living rooms and beautiful green plants with no rotting leaves on them. This beautiful life. The nitty gritty of finance is that there are compensating actions. There's systems that get stuck. There's entire exchanges that got to go out of business. So if you build your own bot, if you want to get into this space, you're at least in control and a lot more understanding of what the commercial things give to you, or you can just continue and own this yourself. Especially if you're in the technology space, you're a programmer. I mean, why not? Why not build all that? Especially, I probably wouldn't do it for something high, with your life savings on something like this, but certainly on these strategies that are like cost average, where you're not doing something on margin or futures or things like that, where your investment can just go to zero, and you're dealing with things that you wouldn't mind actually manually buying yourself and holding for multiple years. There's no reason why that can't be done for you by placing automatic orders on that. The worst thing is that you lock your account by buying these securities, and so that would be kind of cool. So anyway, I hope this sets up a lot of people for event modeling their bots. Just the ideas. We're going to start to add some of these other things as to where the actual processors go. But as I say, to start with event modeling is very easy. You don't need to do the commands. You don't need to do the read models. Just point out where the information gets stored at what point in time, and what that information is talking about, and what people are seeing in real time as you move from left to right by example. And then you can use these events to then build the system underneath that's going to be your bot. And then the nice thing is that the minutia of how you call the API and all of these things is not is not something of your concern. Now that you painted this picture, you now know, what scenarios you want to take care of. You're not just stuck at, well, how do I call this API JSON smart form? That stuff can be easily fixed, and it's not going to be the thing that matters in the end that much. It's how you instrument communicating your information back to you. Do you have some sort of a service on your, some sort of app that gives you warnings? I think there was, what did I have on Android for a while? You can just do custom alerts and all that. Anyway, I had an application on my phone where through a simple API you could throw in whatever alert you want, and it just showed up on my phone without having to make my own app to do that. I think there's a few. I don't know. It's been a while since I've done it, but maybe for next time we can also look at that. And I think we're kind of running out of time for today. I need to get to the office to get ready for the Domain-Driven Design Taiwan conference. I'll be talking about the complete software development life cycle with event modeling at that conference. So if you look at Domain-Driven Design Taiwan, I'm presenting 7 p.m., so about 7 or 8 hours from now. Time zones are crazy, so I'm presenting in my evening, which is their morning, but it's the next day. So anyway, it looks like a fun conference. It's got a cool little video game room type interface. So you go to your different sessions to view them on Zoom, but then you're walking a little video game character from room to room, and there's others, and I think it's something Town is the platform, but anyway, should be fun. A lot of domain-driven design presentations there. I'll be presenting on event modeling from A to Z, but with a specific focus on how you run entire projects using an event model, how it replaces all your Jira, all your estimations, all those regular things we do in software development. How do we replace that with this one nice big blueprint? So that's the thing I do, and I'll be presenting on that tonight. So I want to take the last 10 minutes if anyone's got anything else to add. Anyone on YouTube? We have a thumbs up from Willie James. Thank you on YouTube. So I'll try to edit this down to something smaller and have it as a better video on the YouTube channel, so we can remove the extra things I say that are unrelated, and can have a small bot introduction. And I'll probably do the same thing with the second one, where we get into the code and have a fully fledged event model with the rest of the pieces. Like I said, we haven't gone in to make the read models and to make the commands, but that'll be for the next time, and we'll see where in code those read models and events are. And I'm hoping that I can set up something during the week for a fake or these paper trading accounts, just to have some fun. Or we can make our own, where there's a random number generator that moves the price up and down, and we can have a fake stock price or order book generation just for fun. That's a project in itself, but we can start with something small and fun, and that way it'll allow us to test our systems. So who do we have left today? Not many. Einar, good to see you again. It was really nice for you to join. And
you too.
Yeah, I'm not sure if you work in the same type of industry, but hopefully this was fun.
It's very fun. It's not my industry. I'm in healthcare related stuff, where event sourcing also happens to shine.
Yeah, anywhere there's accountability, right? And you need proper accounting of what happened. I mean, at medicine, where your life is in danger, you need to have accountability of what happened.
Mm-hmm. And you want to make queries like, who has taken this medication, and then this medication, and then this medication, and then 3 years later this happened.
Yeah, exactly. Yeah, those
Good
correlations.
luck.
Yeah, and it's the same thing with this financial stuff. Hey, Elon Musk tweeted about this, and then and then this stock was oversold, and wow, the people that bought this are millionaires, right? So anyway, it's a lot of fun. I hope people start to see more the roots of event sourcing and CQRS and all of this stuff, in how it started on the financial side, but how that level of accountability is really important in the other places, insurance, medicine. It just goes, again, I love it. I use it for everything, and I wouldn't have it any other way, because I want my systems to have that traceability, that audit, that gives me the best courage to move forward, right?
Exactly.
Yeah, we keep talking about agile and how we need courage to move forward because we have a test cases and all this. Well, this is even better. I think event sourcing gives me the breadcrumb trail of how I got there. No amount of tests are going to give me something like that. And I think I tweeted this a while ago, maybe 2-3 weeks ago, about I'll take event sourcing over test-driven design as a safety net any day, simply because I always have a breadcrumb trail of how I got into a predicament. And even if I don't have tests, that is way better for me to figure things out. I have evidence of how I got to something, and even if I didn't have test cases there, that's okay. Not that I don't. I mean, I fully like
it's
test
kind of
first.
a false dichotomy, right?
Yeah, exactly. Yeah, you don't need to have one or the other. You should have both, honestly.
Exactly.
One of the things that I like about this approach of really understanding your state transitions, how your system moves from different state transitions.
It helps you find your units for unit.
Yeah,
tests. So
exactly.
There you have your three
find your
quotes
units
received.
for your unit test. Well, I don't know about that, because unit tests are kind of the word unit talks more about the test itself, not the area.
It makes
right?
no sense. It's a non-term.
Yeah. Yeah. So
what I mean by it is, like, we can.
I know
see
what you mean, because I know you get
the event model that, like, we have these 3 quote received. So I just need to test, like, if I have these quote received, I expect to see this new event appear.
Exactly. Yeah.
And then I can do actual domain level testing of safety order line crossed. What happens then?
This right. Yeah, you have once we get into this next meetup, we'll take a look at exactly what happens at this specific point here. We have a perfect setup of the events leading up to that, and then when that trigger happens, here's our command being sent to put in this other order to get the next safety order in place, or whatever it is that we're doing. So it should be a lot of fun. And then when you have a bot that's a proper event sourced bot with an event model design, it's so easy to explain to someone as to what bots are, how this whole industry can be better for the average consumer. I really want people to how we can make more things available to the consumers. I like this trend of these APIs opening up on exchanges, and I remember I had a startup in 2000, I think, like that, something like that, and I was doing. It was in the financial sector, and it was doing arbitrage for option chains on the CBOE, the Chicago Board of Options Exchange. And there's a whole bunch of calculations that you do for options on a particular security. And for those that don't know, options are the contracts for the right to buy some security at a particular price. So sometimes you hear about that with IPOs. You have the right to buy a stock at a very low price because you're an employee, and no matter what happens with the IPO, you can buy the stock for, your stock option says you can buy them for $10, even though that the stock went, after the IPO went to $70 or $100, you can still buy it at an incredible discount because you're a trusted employee and you're there from the beginning. But options also play outside of the IPOs. They're a market of their own. They have expiry dates, and so you can have these different strike prices. Like, I have the right to buy Google at $2,000. Even though the price may go up to 2,300, 3 months ago I bought the right to buy it at 2,000. So that contract in itself has value of the difference of $300 plus a time component and a volatility component, and all of these things are pretty fun if you're into mathematics. How all of these parameters on the right to buy or the right to sell a stock at a certain price, how they change with different strike prices, different amounts of time left over, different volatility. And because you have so many different contracts with different parameters, they're called option chains, and how they relate to one another. You can find an arbitrage situation if you know the math really well. So I can buy the right to sell at this price and sell the right to buy at another price because they offset one another, and therefore I have an arbitrage situation where I can't lose money. And you just keep listening for that, right? So I had this, but back then, to do this, you had to be classified as a bank, or you had to just have a job at a place. So when I looked at raising money, I needed to raise $10 million to put into effect what I was doing. And there's no way that I could raise that with no connections I had. I mean, I was pretty young at that time, and I wrote everything in C++ for those things, which was a lot of fun. No, I really do like C++. I mean, I had no problems. I'm one of those weirdos that loves pointer arithmetic, and I never had a memory leak on any of my initial courses in college, which was just amazing. I remember just pages of C++ code and not a single memory leak. And I'm like, oh, the prof said, this is pretty special. It must have taken you a long time to do this. I'm like, no, this was last night. It's all done in one night. I was like, what? No, it has no leaks. So that was back then. I'm sure there was other things to do in 2000, but my education was more in the C++ stuff from those years, and that's what I worked on. I still worked on the Amiga up till 1998, all in C++. Yeah. Fun stuff, but
exactly. What was your first computer?
Commodore 64. I learned assembler on it in 1987. I mean, I programmed in BASIC on it in end of 83, 84, something like that. I think I was just a kid, but BASIC is how I started as a kid, and then I reached the what you could do with BASIC, the limits of it pretty quickly, as I wanted to do video game stuff and other fun things. And so by grade 7, I think I was already doing assembler. And because it was like the 6502 was a very slow chip, or was it 6510? I forget. It was a 6502, I think. Anyway, it was an easy thing to. It's not that hard, but it was hard to get the information. All the books in the library were always, the good books were always checked out. You're always on a waiting list for a good book. There was no YouTube, there was no internet, so you really had to dig for information how to do any of this stuff. And now we have, a whole exchange at your fingertips for automating this stuff.
Exactly.
And 20 years ago, I was looking for a $10 million investment.
In the mail.
What's that?
You're not waiting for your new computer magazine in the mail
anymore. Yeah. I enjoyed those Amiga format magazines. Were always so colorful, and that there was always a disc plastered to the front with some new software on it. Those are fun days. Just before the internet, those were the pretty interesting times, and I quite enjoyed it. A lot of people that loved computers, they have the computer clubs and all that. LAN parties. Bring over all the computers together and hook them up. I remember hooking up Amigas with serial ports to play flight simulators and stuff. But
that's awesome.
Yeah, that was those are fun times. But now it's I can just sit here alone and do all this and connect with people on the internet that have the interest. But anyway, I hope that was interesting. The bot stuff. I think it'll be something that people can play with very quickly. Maybe we can just make the project a very inviting GitHub thing that people can deploy to a DigitalOcean or Linode instance, and just press play, and it'll work. So
that'll be awesome.
Yeah, that would be really cool. All right. Well, I'm glad to be having these meetups again regularly, and Einar, always good to see you. I'm gonna head on into the office to finish my day, and if anyone wants to see the domain-driven design Taiwan conference, make sure to look for it online. There's a find DDD Taiwan, and I'll be presenting in now 7 or 8 hours on event modeling. So if you want more info, please sign up, and I'll see you there. All right.
Good luck.
Thank you. I'll definitely enjoy my weekend after this week. I hope you have a good one as well. Thanks, everyone. See you next time.
Cheers.
Bye.